Greetings, everybody. I'm Patrice Rousseau, the Chief Investment Officer of Ashburton Investments. I'd like to chat to you this day on how we're navigating volatility and how our process is ensuring that we deliver steady returns despite very choppy markets. As you would know, markets have been fairly steady for the last decade, and yet we're seeing huge waves, tsunamis building on the horizon. And it's key for investors to be able to look through these difficult times and navigate through them. So let's talk about volatility or these tsunamis. Volatility simply means the liability to change rapidly, especially for the worst. No one has ever really complained about upside volatility in markets. It's a downside we all worry about. So this rapid and predictable change needs to be understood. And I'm here to share our insights on what's causing this volatility and how best to deal with it. So let's look at the past 100 years or so. As you can see, interest rates globally are close to zero. The best things in life are free, as they say. But this is not likely to last. I'd like to take you back a few decades and understand where global interest rates have been. Starting in the 80s with Paul Volcker, who was tasked to really crush inflation in the US. If you look back, inflation in 1981 in the US peaked at 15%. This forced the Federal Reserve to hike interest rates to 21%. Just think about that, 21% interest rate, when now we are concerned about 2% interest rates in the US. This plunged the US into a recession, and inflation really rolled over in 1983 to 3%. In 1988, we had Greenspan appointed as the Fed chairman, and he had to deal very early on in his tenure with a crisis, Black Monday. The Dow Jones collapsed 22% in one day at the end of October 1987. And very quickly, he increased liquidity and flooded markets to try to stabilize sentiment. So that's the first crisis which was dealt with the Reserve Bank increasing liquidity. If we fast forward to the 90s, the maestro, Greenspan himself, had to deal with two crises, the Gulf War and then the 94-95 peso crisis. But he kept things steady. Interest rates were kept at a level which was not too high, not too low. Growth was at 3%, inflation at 3%, and unemployment dropped to below 6%. It was really the Goldilocks scenario. But this Goldilocks scenario led to the dot-com bubble. If you look at 2001, where tech shares really skyrocketed and then collapsed, this again forced Greenspan to flood markets with liquidity and reduce interest rates in order to calm capital markets. That same playbook was later used by Ben Bernanke. So if we look at the 10 years or so to the global financial crisis, we had markets increasing globally fourfold, which really was quite interesting. But Bernanke had the recipe to deal with that. Bernanke immediately started a quantitative easing program. And what we saw since the global financial crisis over 10 years is central banks increasing the size of their balance sheet, flooding markets with liquidity. So the balance sheets expanded fivefold. So let's look at what happened more recently. There was an expectation that interest rates would rise into the 2020 year. And that was deferred. Why? Because we had the global health crisis. You can see from the chart, as the virus spread, economies came to a halt, and we suffered a very heavy human toll. This forced the hand of Jerome Powell. Instead of raising rates, he went from a regime of quantitative easing to really a giant quantitative easing program. All of a sudden, global central banks, the Fed, the ECB, the Bank of Japan, increased their balance sheet by over $10 trillion. And there was another 50% expansion. So more liquidity in the market instead of tightening. The financial market party carried on. You saw asset prices subject to a short squeeze. If you think the oil price increasing looked like it only looked like a massive blip on this chart. Compare that to what the MSCI World did. Again, huge increases, but nothing if you look at it on a log scale. Gas prices, given the tensions with Russia, also spikes threefold. But that was nothing compared to the freight rates, which went up fivefold. But the companies which really benefited from this new regime were the growth companies, the FANGs. They were able to supply data for free. That's what everyone thought. Just giving you some stats, over the last decade, smartphones increased by 24% per annum. The size of ETFs globally, 18% per annum over a decade. And there was a 13% increase in social media users every year for a decade. The lockdown led to a whole army of retail investors entering the market, picking up bargains as markets sold off, and really facing up to professional investors, forcing some hedge fund to cover up their short positions. It was a new world of democratized investing. The governments were not to be left behind. You had a 100-year Australian bond, which was launched, a 100-year Australian bond. And no one seemed to care because most people who were investing in this instrument thought, well, they wouldn't be around if interest rates started to rise. But the star of the show was no doubt Cathie Wood. She invented a whole new asset class, disruptive tech, private equity tech for all in the form of an ETF, and profitable tech perhaps. But the money poured in. Her funds rose to $25 billion in a short period of time. And to make things better, we had the invention of the vaccine. Death rates compared to the spread of the new variants decline. So the pandemic became endemic and concerns eased around the world. So where do we find ourselves? After this really bullish picture that we've just discussed, what is the way forward? I want to speak and step back and talk a little bit of theory. This picture of Thomas Malthus he was quite an infamous economist. He predicted that as population growth increased, the world would run out of food. Luckily, he wasn't right, because farming production and mass-scale farming helped food production to really keep up with population growth. That was really advances in technology which helped that. Let's bring this idea now back to the current environment. Instead of massive population growth, we're seeing growth by itself being a strain on resources that we have on the planet. Every country around the world, every central bank, every politician, every government is pursuing higher growth, higher prosperity, more consumption. And yet we have a planet with fixed or declining resources. This by itself informs a new age of investing, where in ESG, looking at the environment, the impact on the planet, the social impact of investing, and good governance becomes just as important as financial returns. We only have one planet, and we can't just grow at the cost of our environment or causing negative social impacts on our populations. So these constraints that we have is leading to really some unexpected effects. The Federal Reserve, for a long time, didn't believe that inflation was a problem. They used the word transitory several times in their minutes. I remember publishing an article in the Business Day in October 2021 saying that a painful transition was looming, despite what the Federal Reserve or other central bankers were saying. Inflation wouldn't be transitory. In December, Mohamed El-Erian, who's an economist now based at the University of Cambridge, actually said that the whole view of the Fed, that inflation was transitory, was probably the worst inflation call in history. And lo and behold, in December, you had inflation spike in the US, if you look at the cover of the New York Post. And then finally, you had inflation hitting 40-year highs at 7.5% at the beginning of this year. And Jerome Powell had to admit that inflation would be more persistent than he had expected previously. Obviously, this had dire consequences for the markets. All of a sudden, the era of low interest rates seemed to be behind us. In the past, we were used to the so-called Greenspan put. Whenever there was a wobble in markets, whenever things looked dicey, the central banks, especially the Federal Reserve, would be there to rescue us, cut rates, increase liquidity, make sure that things were stable. But in 2021 already, if you look at the chart on the right and the green bar, we started to see quantitative tightening. Instead of expansions or declines in interest rates started going up around the world. This led to a lot of the growth types of stocks and funds rolling over. Cathie Wood, on the left, lost half her assets. Her fund halved in a period of 6 months. To make matters worse, you had Matthew Tuttle of Tuttle Capital Management, who decided to launch an anti-ARC ETF, where he was shorting Cathie Wood and her fund. They call it SARC, short ARC. And Robinhood investors, your DIY investors, decided that they didn't have appetite to play in the markets anymore. They were losing steam, especially investing in these meme stocks. If you look at this report from JP Morgan, you can see that collectively, investors who were invested heavily in the NASDAQ, in the FANGs, changed their minds at the end of last year. Not only they sold their investments, but they went short in a big way. Their favorite instrument, the short triple Q, SQQQ, which was a 3-time leverage short position on the NASDAQ. Triple Q probably because they were queuing out of the door to get their money out of the markets as quickly as possible. This, of course, causes volatility. And volatility we saw. At the beginning of the year, in January, we had the Dow, the S&P, crashing 4% intraday, only to close up. This really rarely happens in markets. The Dow actually has never recovered from a 4% intraday loss. The S&P did so only twice in its history, both during the global financial crisis in 2008. So let's go back to these growth companies. Solid, big, dominating indices. Many felt that they were the companies of tomorrow, that growth would be to the moon, as they say, until Facebook reported disappointing results. Subscribers ground to a halt. Yes, it changed its name to Meta. Yes, there was a metaverse it was investing towards for the future. But current cash flows and growth were non-existent. And Facebook lost 230 billion rand of dollars of market cap in a day. The largest one-day collapse or drop in value in stock market history. So Facebook was the first domino to fall, but it wasn't the only one. If you started to look at a number of these indices which are shot up, look at the freight rate index, the Baltic Dry Index, which had gone up 5-fold, as I showed you earlier, that also came back to earth. But the volatility is still there. The oil price, with noises of conflict between Russia and Ukraine. The gas price, also extremely volatile. And the timber price, which had skyrocketed freefold, also started to come back as the work from home trend and renovation started to normalize. So we've got inflation. There's a new word, actually, shrinkflation. Not only are you paying more for goods, but you're getting less. If you look at the pack on the left, where manufacturers very cleverly are shortchanging all of us. And the smart money knows what to do. Elon Musk not only dumped a huge chunk of his Tesla holding, but apparently, allegedly, he moved to a smaller home in Texas. And that's the picture. We can have a debate whether he really lives there or not, but I think the smart investors are really battening down the hatches for tough times ahead. So let's look back at this whole picture. What's causing volatility? A long decade of quantitative easing, if you look at the gray bars. And now, if you look at the yellow bar, we're heading towards quantitative tightening, not only in the US, but all around the world. And if you look carefully at this chart, we're not seeing any central banks who are currently easing around the world. And this chart is an aggregate of 83 different central banks. So what does the future hold? What are we heading towards? I think for investors, it's quite important to distinguish between two things. There's volatility, but more importantly, volatility doesn't equal risk. It's permanent loss of capital, to paraphrase Charlie Munger, that is a risk to us all. Are you invested in asset classes which are overvalued? Are your asset managers wary of downside risk? Are those who did well last year in the raging bull market prepared for a regime change, for a world where asset prices normalize, where valuations which are sky high get punished, like we saw in the case of Meta or Facebook? I want to speak to the mistakes made by many retail investors. The meme stocks, GameStop being one of the largest, if not the largest, video game or gaming retailers in the US. That was a favorite for many of these retail investors to play and bet on. If you look at the chart carefully from its peaks, that share has halved, and it's still going down. In South Africa, there's a lot of chatter online about Purple Group, again, sky-high valuations. But for me, the poster child of overvalued stocks was Rivian, the electric car company, which listed and got a market cap of $100 billion. To put that in perspective, Ford, the original car company, has got a market cap of $100 billion. And yet, if you look at Rivian, it only produced 652 vehicles and delivered 386 of those. This is from its latest shareholder letter. And you can see, after spiking at its IPO, the share price has halved again. So it's a key message here. Valuations and fundamentals do matter. Just buying into a story or into a fad is not going to protect capital. To illustrate that, I want to talk about global equity funds. These dots represent the performance over the past year of various local and global equity funds available in South Africa. The square in the middle is the performance of the ASISA average of that category. You can see 22% return in rands, really excellent returns from global equities, as I mentioned already, really driven by a bull market. In the triangle in red is the Ashburton Global Leaders Fund, where we invest in global mega caps. Fast forward 1 month, the one-year performance of these funds are vastly different from what we saw at the end of December. The category average went from 22% to the end of December to 7% to the end of Jan. And you can see how the Global Leaders Fund has started to outperform all of its rivals. So what's the message here? At Ashburton, we have a process which looks through the cycle, which is not just geared to the bull market, but also manages risk. And by risk is loss of capital on the downside. We want to do well in the good times, but also protect you in the bad times. And we do so by investing into companies with good fundamentals, which can do well on the up, but also when times get tougher. So that's the end of the presentation. I think we are running out of time, as the picture shows. And we would be glad to sit with you and relook at your portfolio to make sure that you are prepared for the tough, volatile times ahead. Thank you.